Good morning, everybody. My name is Preston Hall from Tax Masters Incorporated. We have been in business for 55 years. We're a family company. My mother started the business back then. I've been running it for the last 15 years. Why do I mention that? Not here to do the hard sell on you folks. We've been in business a long time, and we have a great reputation within the real estate community. So we are here to educate you folks just as a service to you. You want to become a client, you want to send us a client, I'm happy to fire an attorney or a doctor to bring on a realtor, because 80 to 90% of our clients are realtors. That's what we focus on. We used to do, because we're in the area, we used to do a lot of international issues. They've just become so complicated anymore. We'd be drowning in them all summer long. We don't handle a ton of international issues, except for realtors who have clients who are from overseas purchasing properties, so we can help them file their tax returns. But outside of that, we don't love real international issues anymore. Now, we like to start off with this quote from Albert Einstein. And anybody in here who has gray hair like me may remember a time when the IRS would send you a tax return in the mail on paper. You could fill it out with a pen and pencil. A lot of people like to do it with the typewriter. And you would send it back into the IRS, all on paper, nothing electronic. And that was the case for Albert Einstein. When he emigrated to the United States, he was working for Princeton, as many of you may know, anyone who saw Oppenheimer maybe. He was working for Princeton, got his tax return, he got his, put it together, his tax information, spent a month trying to figure it out. Tax returns were 10 times easier back then. Couldn't figure it out. Sent it back to the IRS with a note saying, you all figure this out, right? Apparently, the IRS doesn't offer this service, and this quote came from a conversation that he had with his tax professional that he ended up hiring and working with over the years. And obviously, Albert Einstein's a genius. He's smarter than any one of us. But what he wasn't was a tax professional. Taxes deal more with law than it does with numbers. And that's something that a lot of people don't understand. He wasn't a tax professional. You folks are not tax professionals. You folks are real estate professionals. I know that you're expected to know everything about real estate and that transaction, but when you have something that comes up, like an electrician, you don't try and fix the electrical issues yourself for the client. You have electricians that you use. For your clients, you should have an accountant who understands tax issues and how they affect the situation. Because the last thing you want is to get sued for giving out tax advice, because the answer to every tax question, it depends. When I went to law school, I was a year into law school, which I didn't make it much further than that, in all honesty. But I'm a year into law school, and some girl raises her hand and says, well, what's the answer? We've been going over this case for an hour. It's like, oh my God, even me. I'm like, you're going to be a lawyer? The answer is whatever you can argue, okay? And in taxes, it's whatever we can argue and stay within the law. Okay? There is no right answer. Oftentimes, what we need to do when we're looking for tax answers for clients is we need to look at what has happened in the past. Unfortunately, we can't go back in time. What's going on right now, and what the client is looking to achieve in the future. And then we can give advice as to what we should do and what we can do in the future to reduce taxes and help them build income. You should not give out tax advice. If the client has a tax question, send them to a competent accountant. It doesn't have to be me. I brought my competition here. Nick, I found this guy on Instagram. I'm like, this is one of the few accountants I actually agree with. Apparently, he lived just 30 miles down the road from me. I said, you know what? Hey, I want to have lunch with you. I really agree with your philosophy. Maybe we can send clients back and forth. you send me clients that are good for me, and I'll send you clients that are good for you. But I brought my competition here, and he is excellent in tax issues as well. So I'm not trying to do the hard sell at all. I have more clients than I can handle in any given year. So does he. But we are not your average looking accountants. When we go to tax seminars, the back row is wheelchair parking or the scooter parking. And I wish I was joking. It is that sad. Accountants are dying, accountants are retiring, and nobody wants to go into this field. So find somebody good and latch onto them. All right, let's see if I can speed this up because we have a lot to cover. And I love the recent tax law changes because it's the stuff I've been studying the most recently. And so I get excited about it, but I'm going to try and go through this as quick as possible. I was really excited about this. Biggest jump in tax brackets in years. This is the last 2 years. All this bad news about inflation. Inflation's terrible, but it's good. One good thing is our tax brackets go up, which means if we made the same money this year as we made last year, we pay a little bit less money in taxes. So I was really kind of excited about this because I thought I'd be delivering a lot of good news this year. Who do I do right now? You think I'm doing a lot of Realtors returns right now? No, you guys, you're too busy. I'm doing my W-2 clients this time of year, and they're always expecting refunds. Well, they are paying less taxes this year because of this, but they knew, the withholding companies knew that the tax rates were higher, and they seem to be under withholding. So clients who typically get $3,000 and $4,000 refunds, even though they're paying net less in taxes this year, are owing $1,000, $2,000 more. It's driving me crazy because all I'm doing is delivering bad news this year to my W-2 clients. Why did that happen? They withheld a little bit less money, and everyone's investments did really well last year. So what do we have? FinCEN reporting. We'll talk about that at the end. I'm going to mention it, and we're happy to stick around and answer as many questions as you folks want to answer. I just want to get a lot of information into you folks before the end here. But I do need to mention this. I just don't want to have a discussion about it and slow everything down. Energy home improvement credit. Now we can take up to $3,200 a year in credits for energy efficient things that we do to our home. Adding a heat pump is a good one because that's up to $2,000. We've got windows, doors, the home energy audits, and these are tax credits, better than tax deductions. I won't explain why, but much better than tax deductions. So these tax credits are fantastic, and in the past when we had things similar to this, it was a one-time thing, and then in subsequent years, you weren't able to do it again. So let's say you're putting 2 heat pumps in your house. Well, we can only take up to $3,200 a year. We max out at $2,000 a year. Maybe this year we put the 1 heat pump in, and then that upstairs unit, we replace that the next year. So then we can take advantage of this. Just something to think about for your clients. If you know that clients are making big improvements to a house, tell them to talk to their tax professional and mention this. I was giving bad news earlier this week, W-2 client, like, dude, you usually get back a refund $3 or $4 grand. This year you owe $3,000. Guy makes plenty of money, so I knew that the owing money wasn't going to hurt him. I said, look, your W-2, there's not that much I can do for you, but did you happen to do any work on your house this year? Like, I don't know, do something with your HVAC? He's like, oh yeah, sends me a bill. He spent $36,000 on a heat pump. Like, God, I should look up his address. How big is this home? But now his tax bill's reduced by $2,000 just because I remembered, oh yeah, maybe, just maybe. And I notice a lot of people fit into one of these categories, so I can save them a couple bucks here and there. Now, in my neighborhood, I've seen a couple of these going in for the residential clean energy credit. I need you to think geothermal or solar. These are expensive projects, as you well know. And if you have a client, there is no income limit on either of these, correct? There's no income limit, which is really fantastic. But especially, people putting solar and geothermal usually make pretty decent money. But if you're putting in geothermal, then or solar, you can take up to 30% as a tax credit and there's no limit. So if they spend $30,000 on geothermal, they can save $9,000 in taxes. So you see clients doing this, point them in the direction of their tax professional and say, look, make sure you tell your tax accountant this. If you're the one who tells them to do that and they go save a bunch of money in taxes, hopefully you've got what I like to say, client for life. You folks...
Don't tell them to do that. Tell them to consult their...
What's that?
Solar.
For solar? Before they do solar? Well, because of the... yeah, I know what you're talking about. If they're doing financing, is that what you're... Yeah. I'm just saying, if you see it already happening. Yeah. So this is one of those things that I completely missed in all my classes last year, and I just happened, a client mentioned it to me, but it's the alternative fuel vehicle refueling credit. So what is that? If your client is putting in a charger for their car, they can put in their address on this website. All the accountants in my firm still can't figure out this website. I'm the worst accountant in the firm. Okay, every accountant I have on my team is better than me, but I do know how to use this website. And so you put your address in the website, and it says whether or not you qualify and in which year you would qualify for the credit. But you can save up to $1,000 on installing a charger if you're in the correct area. They're typically looking for lower income areas or rural areas. So you say, okay, well, that's nothing in the DC area. You pull up this map, and it's a patchwork quilt. There are areas with $1 million homes in DC that qualify for the lower income portion of the credit. And there are areas right in this county, a lot of areas in this county, that qualify for the rural credit. There's also areas that qualify for the low income portion of the credit. So just something to think about, okay? Don't be giving out tax advice, but also for you. If you put one of these in, make sure you mention it to your tax advisor. Electric vehicle credit, this is turned into something that is clear as mud. Some vehicles qualify, some don't, some based on price, some based on where the batteries were built. But you can get up to $7,500. A lot of them do qualify for the full $7,500, but there's also income limits. So we've got all these different things. What's the workaround, Preston? That's what I'm here for, right? Is the workaround? The workaround is if you're amenable to a lease, which usually I'm not, but if you're amenable to leasing your vehicle, then the lease company is oftentimes, most times, allowed to take the full $7,500 credit. And then they will work it into the price of the lease. You're still going to be paying, more than you should, but that's why you've probably seen a lot of advertisements lately, or maybe I just play with too many cars online, but you see a lot of advertisements for low lease payments on electric vehicles. It's because they're able to write that $7,500 right into the lease amount. Now, in 2024, if you qualify for the credit and you have to sign an affidavit saying that you do, or you did last year, you may be able to, and you're purchasing the vehicle, you may be able to take that $7,500 off the purchase price right there at the dealership. So also something to think about. So you're going to want to, if you're doing this, you may want to talk to your tax advisor before doing it. All right, so now the presentation starts. How am I doing on time? Good Lord. All right, so we've got 4 taxes to talk about today that each one of you pay. The first is your federal income tax. That's the one you're here for, right? That's where I want to save all my money, is on my federal income tax. And as you can see, it doesn't take much in this area to get into that 22% bracket, okay? Then we've got your state tax. 2 taxes now, right? And for you Virginia folks, as you can see, it's 5-6% or so. Don't talk to me about the personal property tax. You still save more money in taxes than us folks in Maryland and DC. I really want to move to Virginia. When you start doing the math on that, really want to move to Virginia. Okay, so that's 2 taxes you pay. And then 3 and 4, I'm sure you probably all remember this, the self-employment tax. It is composed of your Social Security tax and your Medicare tax. And I wrote these numbers down because last time I said 3.9 instead of 2.9, and somebody looked it up in class. It's like, it's 2.9, not 3. Not here for the numbers. Big concepts. Okay. So, if you were an employee, you would pay 7.65%. Your employer would pay, you guessed it, 7.65%. But you're all self-employed, so you get to pay the employer portion and the employee portion at 15.3%. Anybody doing the home game or got a calculator out, your total tax, maybe 2% less than that in Virginia, 45% for any income for which you do not have a business deduction. All right? What's the key word there? Business. Because when people think of deductions, they often think of their house or charity. But you folks need to think of things a different way. Because with our house, we can write off the interest on the principal paid up to $750,000. We can have 2 houses, a secondary home. But in aggregate, the most we can write off, if we have 2 houses, the most we can write off is the interest on $750,000. If you have $1 million, we just take the interest on the first $750,000. On your home, we can write off your real estate taxes, but we've got the SALT limits. $10,000 is all we can write off in state and local taxes each year. That's not a lot in this area because we're already paying a lot in income taxes in this area. So oftentimes we don't get to write off much of those real estate taxes. Those 2 items, plus your charitable contributions, they only save you on 2 taxes. Your federal income tax, your state income tax. Doesn't save you any money on your self-employment tax, your Social Security tax, and your Medicare tax. But as realtors, we can do something to save some money on that Social Security tax with our home. Office and home. Be honest, because this has changed a lot in recent years. Is anyone's accountant telling them that office and home is a red flag? 1. Good. That's about right for these days. If I had asked that question 10 years ago, half of you would have raised your hand. You need to fire your accountant. And I'm not, yeah, I am, the last thing I want to do is badmouth other accountants. Right. My God. The last thing I want to do is badmouth other accountants. I don't tell people to fire their accountants because I don't have the capacity anyway, for the most part. Office and home's been not been a red flag since 1999. We've been proselytizing this since 2000. And if I asked this question 10 years ago, half the room would have raised their hand. What happened it was about 9 years ago. The IRS said, office and home is not a red flag. Not only is it not a red flag, we're going to make it easy on you. Oh, I just realized. That for the video, that is going to drive people crazy. Me going, I'm sorry. I'm sorry. I cannot stand still. Guys, seriously, thanks for having me out because we're all chained to our desk for like 12 hours a day staring at a screen. So the fact that we're out here during tax season is like, oh, thank God. Thank God. I can't check my email. All right. So the IRS says it's not a red flag, folks. Not only that, we're going to make it easy on you, right? The IRS is making something easy on you, and this is where we see if people are paying attention. Is it saving you money? No? Is everybody playing on their phone? If the IRS is making something easy on you, is it saving you? Yes, thank you. They said, we'll give you a simplified method. You just do a quick calculation. It's right on the Schedule C. Super easy. Don't worry about. I haven't asked you to write anything down. This is the only thing I'm going to ask you to write down all day. 8829. Okay? If your tax return doesn't have an 8829, Either you're too disorganized for your accountant, or your accountant's being lazy. And if the accountant's being lazy, fill out those forms, give it to your accountant, and make them do it right. Why? Because if we maxed out the simplified method, the most we would be able to write off is $1,500. My average office and home in this area is way over $3,000, typically around $5,000 of a write-off. Let's say it's $4,000 and you're paying 40% in taxes. I'm saving you $1,600. Okay? Don't use the simplified method. Do it right. Because when we do it right, we get to deduct a percentage of that mortgage interest that was only saving us 2 of 4 taxes. Our real estate taxes, which we probably didn't get to write off because we make enough money in this area to already hit those SALT limits. We can write off our homeowner's insurance. Couldn't write off that before. Cleaning, trash removal, repairs, utilities, HOA condo fees. We can write off all of that. You rent? Great. Well, some of my renters, they live in apartments that are 900 square feet. They've got a 150 square foot office, and they pay $30,000 a year in rent. My renters oftentimes have the biggest deduction for office in home. So it is not only one of the bigger deductions that most realtors take, but it parlays into something else that's very important. Office and home. So we don't have an office and home. We get up, we check our email, we go into the office. I know most of you folks work from home, so it's even more important that you have an office and home. But, okay, we check our email, but we don't have an office and home, not on our tax return at least. And then we go and we show a client, drive this client around all day, and come home. That first trip and that last trip was not business miles. Leaving the house and coming back to the house. It wasn't business miles. That was commuting. Commuting is just the same as personal miles, not deductible whatsoever. If you have an office and home, that first trip of the day, that last trip of the day, is you're going from one business location to another business location. You're going from a business location to back home to a business location because you folks are self-employed. I run a business. You run a business. The first thing you do is get down to your office and get to work. The first thing you do when you get home is check your email, see what came up, or write up that contract when you got home. You're going from business location to business location. If you don't have an office and home on your tax return, good luck justifying 50, 60% business use of your car. And if you've got 80 to 90% business use of your car and don't have an office and home, that's a way to have an IRS red flag. And that's the only red flag we've ever seen in 50 odd years. Well, let's not talk about the dark ages before 1999 because we would see IRS audits on office and home back then. But the only one we've seen since 1999 was somebody, we didn't prepare the return, didn't have an office and home, had 30,000 miles a year of driving, comes to us to handle the audit. We ask him about his job. He's like, of course I have an office and home. But my realtor told me not to, my tax accountant told me not to write it off. We amended the return, brought it to the audit, and the auditor took it and was like, oh, well, this changes everything. No change audit. Okay, so make sure that you've got that office and home, especially if you have high business use, because for most realtors, I'll get to you, for most realtors, your largest line item deduction is either going to be your vehicle expenses or your advertising. Advertising, I don't see a ton of last like 5 or 10 years, but we used to have $20,000, $30,000 on a lot of realtors' returns back in the day. But, oh, there we go. I guess I was one ahead of myself. What's your question before I? Are you applying to you have a home office? No, because Well, you wouldn't have commuting miles anymore. I mean, unless you woke up, didn't check your email, right, and then drove to a business location. But I haven't, for all of my clients have office and home, except for except for my ones who are not realtors. I can't think of a realtor off the top of my head who doesn't.
Like I work in my house. Is that like, so I don't have commuting miles.
What I put, because there is an area on the tax return is like total miles, commuting miles, business miles, right? I've got total miles and I've got business miles. Almost never put anything in. It's forget about differentiating. Like my clients just don't have it for the most part because they're not commuting. You folks are the clients that we deal with. And so, there's typically not going to be any commuting miles. Do you take the same approach with that? Yeah. Right. It's not right.
I did this for years, and then my accountant recently stopped doing it because maybe my situation changed with the S-Corporation, and he said if you take this deduction, then you don't gain that there's a certain amount not exempt from capital gains.
Let's put it this way. S-Corp is a complete. I'm glad you mentioned that. S-Corp is a completely different ball game, and so that's a 30-minute conversation, and he's not incorrect. There, I get what he's doing philosophically. There is a way to do this from an S-Corp perspective, but I'll answer that after the fact. If you have an S-Corp, some of this stuff is going to be a little bit different for you, just so you know. So actual and standard mileage rate. Actual expenses versus standard mileage rate. Is that what I'm on? Yeah. Really, 95% of my real estate clients, actual is going to work out better for you. I can give you the case where standard mileage is going to work out better for you, is if you have a reliable vehicle and you do a lot of driving and that vehicle is pretty old. And that's going to be about it. Every other realtor is going to be, you're typically going to have a more recent automobile, so we can take the depreciation on the vehicle, and so it just ends up being significantly better deduction to do actual expenses. In both cases, we have to track the mileage, because with the standard mileage rate, we need to know how many business miles you drove, right? Whereas with the actual expenses, we need to know the total miles and the business miles, and we apply that percentage to your depreciation, your oil, your gas, any repairs, your insurance. And so that is where, that's why the actual tends to work out better for 95% of my realtor clients. Let's see here. It is, in some cases, it's getting a little closer now that business miles are at 67 cents per mile. But if you are in the standard mileage camp, and very few people know this, we can take a percentage of the interest on your car loan, all your business parking and tolls, and personal property tax for the Virginia folks. Okay. But like I said, standard mileage rate is not usually the better way to go. I'm going to come back to the 25 and say, because this one starts the most debate. And it's like, what's that? Oh, you're up. All right, I'm going to take a break.
Don't worry, I'm going to stay right here. All right. Investment properties, rental real estate.
Oh, yeah. All right. You don't want to hear my heavy breathing and drinking?
All right. Investment properties, rental real estate. I'm sure we can all agree rental properties are good investments. We would recommend them to a lot of our clients who are looking to get into this. And not only are they good, they have good tax implications as well. Now, I'm sure if you're looking at the screen here, like it doesn't look like there are good tax implications, but this is mostly to say there are some things to be aware of with rental properties. There are a lot of rules around them. Not only this, but we're not going to get into this today, but there are also things like Is this a vacation rental, a long-term rental, a short-term rental? Are you a real estate professional? You're not a real estate professional. You're materially participating, or are you just actively participating in this? What are your personal use days? What are your rental use days? A lot of questions when it comes to just buying a piece of real estate in terms of your tax return, right? But one of the biggest things that impacts the most amount of people that are not real estate professionals is this passive activity loss limitation, all right? Most of the people that are going out buying rental properties that are not real estate investors, right? They're people that are high W-2, they're looking to increase their portfolio of investments, they're buying some rental properties on the side, right? They're gonna be subject to these limitations right here. And this is what this is. When I buy a long-term rental property, right? So I'm gonna rent out for 12 months or so during the year. When I buy that, I put this on Schedule A on my tax return, and I have passive income or passive losses, right? If there's net income at the bottom, that's a passive income. If there are losses at the bottom, right? So my expenses exceed my revenue, then I have a passive loss. Those passive losses cannot go against your active income for the majority of people that are not real estate professionals. Cannot go against your active income, like I can't reduce my W-2 income, and it cannot reduce my business income and things like that. Unless, if I make under $100,000 a year, I can actually take up to a $25,000 loss for my rental property, right? So if I made $10,000 in rental income and I had $35,000 in expenses, I have a $25,000 loss for my rental property. And with this exception, if I make under $100,000, I don't know how I afforded this rental property, I don't know how I'm affording all these costs, but I did. And I can take that full $25,000 against all my other income, W-2, business, whatever, right? But as I increase from $100,000 to $150,000, this $25,000 exception of passive losses from my rental real estate that I can take against my income phases out, phases down to zero. Once I crest $150,000, I cannot take any of those passive losses against my active ordinary income, like W-2, business, things like that, if I'm not a real estate professional, right? I am capped. So that means that $25,000 loss to someone who has a $200,000 W-2, that's not going to impact his tax return. He's not going to be able to reduce his income by that loss. Now, he doesn't lose it. That passive loss carries forward until he has passive income for it to be used against, right? So if he has another rental property, or if this rental property has a better year, the next year has net income and things like that, that passive loss that carried forward will mitigate that passive income in future years. So it's not lost. And if, let's say, he never has positive income on this rental before he sells it, he will still have all these passive losses carried forward until it's sold, and then those passive losses will be used against that. But you might be thinking to yourself, well, okay, so you're telling me that if I'm an individual, not a realtor, not you special people, if I'm an individual and I buy this rental property, I'm not going to get any benefit tax-wise? I can't take this loss against my income? Well, what's the point? Well, the point is this. We got to stop thinking about these investments solely from the tax deduction side, right? Look at this as the equity builder that it is, right? Look at this the way you should. When we invest in real estate, we as realtors, I also have my real estate broker's license. I deal a lot with investors and things like that as well. When we are looking for properties for our investors to buy, we're looking for good cap rates. We're looking good return on investment for the real estate. So tax deductions are great, but that's not the primary purpose of someone purchasing a rental property. It's to actually become wealthy. It's actually to make money, right? That's the primary purpose. Having a tax deduction is a secondary thought. But what we really want to look at is the real tax advantage for real estate is they are essentially another form of tax shelter for you. And let me give you a quick example here. So let's just look at this cash flow side right here, right? So on my rental property, when I buy this, I'm just looking at the cash in, cash out for the year. Let's say I buy a $500,000 property, I rent it out. It's got a $400,000 basis I'm going to depreciate, right? So it brings in $45,000 rental income. I have my mortgage payments. I know this is not all deductible, cash in, cash out. That's all we're looking at here. Mortgage payments, insurance, taxes, repairs, supplies, right? I got all these expenditures. I got $40,000 going out the door. That means at the end of the year, my bank account started with 0, got 45, out 40. I have $5,000 more in my bank account than I had before, right? Went from 0 to 5. $5,000 in my pocket. Now am I going to pay taxes on that? Well, I don't know, because that's just my cash in, cash out. I need to look at my tax return, right? What I'm going to be reporting on my tax return is my rental income, my interest for my mortgage, and interest rates today, pretty high. I got all these other expenses, right? Then I have one extra expense right here, which is my depreciation. Well, my depreciation, 27.5 years of that $400,000 depreciable property is about $15,000. I got a $5,000 loss on this property, right? So on my tax return, I lost $5,000. Now, if I'm over $150,000, yeah, I can't take this against my income. It's not going to reduce my income, reduce my taxes. But guess what? I'm not going to pay any taxes on this. Pay no taxes on this. I'm $5,000 richer. I'm not going to pay any taxes. In fact, I have a carry forward loss. It's going to go ahead and send you future income from this rental property or another rental property that I have. So while I'm cash flowing, I'm making money, I'm physically richer than I was before. You're like, $5,000 isn't that much. It's more money than you had before. I'm $5,000 richer, not paying any taxes on it. And I have this non-cash depreciation deduction on an asset that's appreciating with a tenant who's paying down my mortgage. So my equity grows and grows and grows every year while I'm not paying much or any tax on this income. Probably making a little bit of money throughout that time, helping me buy more investment properties that result in more depreciation, maybe more expenses, more passive losses, keeping me pretty even keel on the amount of tax I'm actually paying on this rental income that is putting cash in my pocket, not costing me anything tax-wise, building up my actual wealth, making me a guy who makes a few $100,000 into a millionaire who's also making a few $100,000 because rental real estate's really where you build your wealth, right? That's the advantage. I know everyone is so concerned with these write-offs. They come to you like Grant Cardone said, if I go out and buy a rental property, I'm going to be able to cost seg this, I'm going to be able to write off all my income, I'm not going to pay any taxes. Grant Cardone is right for real estate professionals in being able to do that kind of stuff. But Grant Cardone is wrong for the vast majority of people. The majority of people who are listening to him on TikTok are going to go out and buy this property because they're going to spend all this money and be like, where's my deduction, tax man? No. You make too much money and you're not a real estate professional, right? So it is important that your clients, you are not a tax professional, right? Going back to what Preston said, you're not a tax professional. But what you can tell them is, hey, that's awesome. We should absolutely look for that rental property. We should definitely do it. It's a great investment. I'm going to find you a good return, and you're going to go talk to your tax accountant about how it will impact you tax-wise, because you don't know their whole tax situation. You don't know, and you also don't know what they're going to use it for. Are they going to use, again, they're going to use it personally a little bit? So is it going to be a vacation rental? Are they going to do a long-term or a short-term rental? They need to talk about all these things with their tax accountant so they can figure out how it will actually impact them. But what you know is good investment. It will make you money, and maybe tax-wise has no real impact on you and shelters some of that income. Then there are a couple other exceptions, right? There's the $25,000 one. If you don't make over $100,000, right, you can get $25,000 of a deduction from those passive losses, right? But then there's the ultimate one, which is real estate professionals. Real estate professionals have what I think is this and being a day trader are two of the biggest get out of tax that I've ever seen. Day traders get to trade stock and they get to take mark-to-market election, things like that, right? But then they can take all their expenses on Schedule C. They just have a loss there. They pay no self-employment tax on their income. It's amazing. Real estate professionals, you also have something pretty similar to that with real estate, right? So if you are a real estate professional, not a realtor. I'm a realtor. I'm not considered a real estate professional by the IRS standards, right? Because in order to be a real estate professional, you have to work 750 more hours in real estate trader business, right? During the year, that's about 15 hours a week that you're working in real estate, right? So that's the minimum, that's the floor you have to reach. You might be like, I reached that. Great. Over half your working hours must be in real estate trade or business. Real estate trade or business would be like brokering real estate. It would be building or demolishing or landscaping or property management, things like that. Those are real estate trade or business. Over half your working hours. So what this would mean is if I have a full-time W-2 job, right? Full-time W-2 job, I don't own this business. Full-time W-2 job, not in the real estate industry. That means I'm getting paid for 40 hours a week, about 2,080 hours a year. I would have to have 2,081 hours in real estate to be a real estate professional with that W-2 job. So unless I'm working 80 hours a week, probably not going to happen, right? Very hard bar to reach unless this is your main activity of what you do. That's why realtors have the best opportunity for this. Now, if you're a part-time realtor, you can say, well, all my activities in real estate, but if you don't reach the 750 hours, you're still not a real estate professional. And the advantage, and then you materially participate in the property. Material participation is a concept for another day. But if you are a real estate professional, that means those rental losses, no matter what income you can make $1 million. Those rental losses that you have on Schedule E, passive losses for everyone else, for you, those get to go against your active income. You can reduce your business income, you can reduce your W-2 income, whatever it is. Those losses from your real estate can go against your income immediately. You do not have to carry them forward and go against other passive income. And it doesn't change necessarily the nature of this income for the IRS. in that I'm still on Schedule E. It's still passive income. So let's say that rental property doesn't have a loss, has income. I'm a real estate professional. Does that mean I'm going to be subject to self-employment tax on this? Nope. Still is passive income. Still will be void of that self-employment tax. Real estate professional is a fantastic designation. There are also some things on the back end, like when you sell your property, NII tax and things like that. Don't have to worry about that. So there are a lot of advantages to it. Yes, that's a good point right here. So let's say you have spouses. That is a fantastic point. If I have spouses, one spouse, high W-2, the other spouse, realtor. Man, power couple, love it. Now you're going to go out buy a bunch of real estate properties. They're all under the realtor. They're all under them because they are a real estate professional. They are taking that loss, and they benefit on their joint return because your spouse benefits from whatever the other spouse does in terms of their business, activity, and things like that for their income. So it's a good point. Then there's the most common one. So if you're on social media, you've probably seen this. The other way around these passive activity loss limitations is the 7-day rule, or you might have heard of it called the short-term rental loophole. Not necessarily a loophole, it's just following the tax code. What this is if I rent out a rental property for 7 days or less, according to the Internal Revenue Code, regardless of substantial services, if you want to argue with me on that, we can. Regardless of substantial services, if I rent out a property for 7 days or less on average, so I have a short-term rental on the beach or something like that, right? Throughout the year, 7 days or less on average, this is not treated as rental real estate. And if I have something that isn't treated as rental real estate, it doesn't go on Schedule E. It goes on Schedule C or F. And this isn't a farm, so it doesn't go on Schedule F. It goes on Schedule C, right? Just like if you're a sole proprietor or a single member LLC realtor, your business earnings and deductions go on Schedule C, right? Or you're going to be subject to self-employment tax. So does this short-term rental. And so if I materially participate in this short-term rental, right? Okay, well, I'm on Schedule C. It's active business income. And if I have losses, just like we're talking about, like, I have losses credited through depreciation, things like that for my rental property, I can take that loss against my income, regardless of how much I make and things like that, because it's no longer real estate activity. It's no longer rental real estate. This is a business. The 7-day rule essentially is this. They're saying you're a hotel. You're a motel. You are not a long-term rental. You're not an ordinary passive activity. You're not actively involved in this. Augusta rule is a little bit different. Augusta rule is if I rent out one of my residences for 14 days or less in toto during the year. Yes. This is 7 days or less on average. Yes. So I could have 150 rental nights, but on average I have a bunch of different tenants that are renting it out for me 7 days or less on average. Right? So that's what the 7-day rule is. And here's the thing. And so what a lot of people will say is, okay, sweet, we're going to do a cost segregation on this property, right? And we're going to take some beginning year bonus depreciation on that 5 and 15-year property. We're going to get you a $50,000 deduction that first year. That's sweet. You reduce your income. It's fantastic. Kind of makes up for what you put out of pocket for the down payment. The only problem is, remember, little word of caution. You're on Schedule C. This property is going to be subject to self-employment tax if you make income, right? So if there's positive income, it's subject to that 15.3% self-employment tax. So, yes, this exists. Yes, it's not bad. It is good to understand the back-end consequences. It might be a good first year thing, but going forward, you might be paying additional taxes on this. Whereas if it was on Schedule E, just a regular rental, you wouldn't at least have this additional, self-employment tax.
One way or the
other. That's a great question. So, can they switch? Absolutely. What if your activity changes in the property? So, what if I
scheduling from C, like, I have two short-term rentals.
Mm-hmm.
And, like, obviously the first year, switch it.
So do I think that could create an audit? Yes. Do I think you might? But is it defensible? Of course. What if in the first year I legitimately rent out my property multiple times throughout the year? More than just in December I rented it out for 7 days and I called it a short-term rental. But let's say I rented it out short-term in that first year and I put it on Schedule C correctly. That's what the Internal Revenue Code says to do, right? But then the next year I'm like, you know what? I'm tired of dealing with these transient people coming in and out of my place. I want to just make this a long-term rental. I put it as a long-term rental. I should switch it over to Schedule E. It's no longer business activity. This is rental. So yes, it can. And it could switch the other way. It could go from Schedule E to Schedule C. The more you do this, though, the more likely you are to be audited on those kind of things. So
it's how spicy do you want your chili? You're not the first person. I mean, we have clients who have come with, and oftentimes we try and get them to avoid the 7-day rule or taking that approach from the get-go. I'll get
a lot of people are doing this that are not real estate. They want a way to take these deductions. I always go with it. That's fine. You can do whatever you want. You can do whatever you want. And I'm going to say, yes, you will get a large deduction this first year. Do understand. And I've told them every time, you're on Schedule C. You're going to be subject to self-employment tax. If this stays a short-term rental, these produce good money. You're going to have income. Your depreciation is going to be much less in future years because you took a bunch up front. I changed the nature of my deduction. So I'm going to have a lot less depreciation, that non-cash expense, reducing my income. So I'm probably going to have positive income on this. That's fine. You're making money. That's great. But it's going to have an extra tax from self-employment. So it's just important to understand that. If people wish to do it, hey, God be with them. I will prepare the return for them. That's no problem at all. But, and again, I have a lot of people that are doing this. They're working with these advisors that are telling them like all these different deductions, and that's fantastic. We certainly can. We need to stay within the line of the tax code, and if we do that, we're good. Here's the consequences. It's good for people to know both sides of everything. Here's the deduction. Here's my plan. Here's how it impacts you tax-wise. Here's how it impacts you tax-wise in the future. Don't just look at things in the current. Look at things long-term. There is a defense. I would definitely say there is a defense for, based on some memorandums and things like that, where the 7-day rule, if it is truly a passive activity, you can make a defense to put it on Schedule E, make it passive, right?
I would love.
And for any of the real estate professionals, I would say, don't get a short-term rent. You have the advantage of putting on Schedule E. You're not subject to self-employment tax. You're able to take these losses against your income. Do what you can to do that. So you guys are unique in this, right? In that you guys are in this field. It's fantastic. It really is a great field to be in. That's why everyone's wanting to do it. That's why Robert Kiyosaki talks about it. That's why Grant Cardone talks about it. That's why Chris Crone talks about it. That's why all these people that are wealthy talk about this, because it does provide a lot of wealth. All right, and then last one. A favorite question that I get asked all the time is, should I be an S-Corp? And I'm sure you've probably been told by everyone and your grandma, you should be an S-Corp. Why? Why should I be an S-Corp? Well, to save money on taxes. How? How am I saving money on taxes? Well, the first thing is, remember that 15.3% self-employment tax, right? You as the employer and employee pay 15.3% tax. Well, with an S-Corp, I'm able to control the amount of FICA tax, the amount of Social Security Medicare tax that I pay. You're not eliminating it, but you control it, right? On a Schedule C, if I file my taxes, Schedule C on my personal tax return, I'm a single member LLC or a sole proprietor, I get a 1099 in my name, right? I have my business earnings and deduction on Schedule C. It's where I take my home office deduction against that, all that kind of stuff, right? But it's all going to be subject to self-employment tax. Whereas on the S-Corp, only that which I pay myself W-2 is subject to self-employment tax, or that FICA tax, right? And the rest is just business income that isn't subject to that. Let me give you a quick example. Let's say on a Schedule C, you're just a sole proprietor, you're making $150,000 of net income in your business, right? Your commissions, less all your expenses, $150,000 on Schedule C on your personal tax return. I'm going to pay, because remember, the only thing I really care about here is self-employment tax for this first example. This is the primary reason people will switch over. Then there's some other reasons as well. But the primary reason is self-employment tax, right? I make $150,000, 92.35% of that's going to be subject to a 15.3% tax. I'm going to pay $21,000 in SE tax on that $150,000. All right. Well, let's say I take the same business, but I'm on an S-Corp, right? So now I got $150,000 of business income in my S-Corp, and let's just say I pay myself $100,000 W-2, right? So that W-2, the employer pays 7.65%, and I, the employee, pay 7.65%. And by golly, I'm both, because the S-Corp is me, essentially, right? The S-Corp is my company, and it hired me, but I am all one. So I paid $15,300, 15.3% on $100,000. Right there you go. $15,000 versus $21,000, I saved $6,000. My income did not change. I'm still going to have, on my tax return, $100,000 W-2, $50,000 business, I have $150,000. Whereas the Schedule C, just $150,000 business. I have the same amount of income. I'm still going to pay the same amount of tax. The S-Corp does not pay taxes. It all flows through to you personally. You're going to pay tax on it. But I saved on that one particular tax. So that's the first primary reason people will switch over. So at a certain level of income, it makes sense, because you can pay yourself a fair and reasonable wage that is lower than your net income, and you'll be able to save on that FICA tax. So that's the first thing. The second thing is taking advantage of a higher QBI deduction. So QBI, if you guys are aware, so the simplified QBI is essentially 20% of your business income you get a deduction for, right? So if I made $100,000 of net income in my business, I'd get 20% of that as a deduction to my taxable income. Well, if I was on the S-Corp making the same $300,000, pay myself that $100,000 wage, at least I have some wages to calculate some QBI. I'm going to get 50% of that as a deduction. Pretty sweet. Now, do you understand QBI? Much longer concept. The calculations are a little bit more robust. But just for a simplified example of what this is, you begin to phase into a different type of QBI deduction. So the S-Corp, you're paying yourself a wage. Not only are you saving yourself an SE tax, but you're also keeping the QBI deduction as things change for you and making more money. Lower audit risk. The typical was like it's 5 times lower audit risk to be on an S-Corp.
That's pretty low.
Yeah, than the Schedule C. IRS knows Schedule C is really easy. Business income, business deductions, what looks too high. The S-Corp, you're talking basis, you got a balance sheet, you got an income statement. There's so many more things involved in this. They don't want to audit those because there's just so much more to do. And generally speaking, those taxpayers have a professional preparing it for them, and so they don't really want to deal with it. A lot of Schedule Cs are individuals preparing their own tax return. And then remember that SALT cap, the $10,000 SALT cap, right? We can get around this with a pass-through entity. What's really cool is Virginia has this, and they do
before Maryland, or was it?
They might. I don't know.
Okay.
Either
Virginia does have it.
both Virginia and Maryland have this, and a couple other states. I think Ohio has it and things like that. This is called the pass-through entity tax election. So I can take do you make estimated tax payments during the year, quarterlies, right? You pay to the state, you pay to the Fed, right? None of those are deductions for you, correct? Those are just personal payments you're making towards your taxes. Well, you can make an election in your S-Corp, in your pass-through entity, usually it's a partnership or an S-Corp. You can make an election to pay the Virginia resident share of taxes for the income of that year, and it's going to be a deduction for them. What I mean by that is this. Let's say you make $200,000 of net income in your business. Well, I'm going to take, let's say it's 6% for Virginia. I'm going to take a $12,000 deduction to pay the state taxes for that individual. So I'm paying my estimated taxes for that business income, $12,000. That's just my estimated tax in Virginia. I'm paying it, and it's a deduction federally, so it reduces my taxable income federally. It's pretty sweet. And I was going to pay it anyways. I was going to pay that tax regardless. Now I get a deduction for it, and now I don't have to worry about that SALT cap limit, right? So that includes your state income tax paid, as well as your property tax paid, as well as your personal property tax paid. So now I don't have to worry about that. It's not included in there anymore. I already got the deduction for it. And now I still get I probably have enough other things in my SALT to get me to $10,000 still. So that's another fantastic thing, also reducing your income for something you're already going to pay. So that one's pretty sweet. It's not available if you're on Schedule C. You have to be a pass-through entity. Disadvantages, obviously additional filing. So I have an 1120S to file instead of just the Schedule C in my personal tax return, which does come with additional costs. Again, like I said, there's more things involved in this. So that's where you're really going to need some good bookkeeping because we're going to need a balance sheet and we're going to need to keep track of your basis. It's a lot more important to have that. And then also you have to set yourself up on payroll. Okay, that's kind of a headache. It has a cost. And again, bookkeeping is going to be really necessary, especially as a realtor. We have a lot more cyclical type of income, right? So it's going to change month by month, season by season. And so running yourself a reasonable salary is going to need to be looked at least quarterly for yourself. So that way you're not doing a December Hail Mary last end of year paycheck where you're paying a bunch of FICA taxes just to get your W-2 to be reasonable by the end of the year. So bookkeeping is definitely going to be necessary. You're going to have a little bit more headache, a little more administrative cost to go along with this. You have a little more compliance as well, such as year-end minutes and again, making sure that your basis is probably taken care of. And then last thing to be aware of is you might say, okay, well, I elected S-Corp status because things were going really well for me, but then I'm kind of, I'm trailing off a little bit in real estate, or I just have a bad year that year and a good year this year. You cannot switch on, switch off this S-Corp election. If you make it, stick with it. Because if you decide to terminate the S-Corp election, which you're allowed to do, say you have an LLC, you make the S-Corp election to be treated as an S-Corporation, and then the next year you're like, I don't want it anymore. I'm going to terminate my S-Corp election at the beginning of the next year because I don't feel like paying myself the payroll and things like that. It's fine, but you have 5 years until you can make another election with that LLC again. I cannot make another either C-Corp or an S-Corp election. I cannot do that for another 5 years. So if you're wanting to make another S-Corp, you're going to start another company to do that. So be aware that there are things that can happen if it's not going to work out for you. So when you make the S-Corp election, make sure that you are prepared to do so. Recommendation would be you want to be making their recommendation around 180K. I would say for my firm, start thinking about it at 100K, 150K. It makes sense. The costs, right, will be outweighed by the tax savings, right? That's what we're looking at. When we recommend it, we're saying your costs will be too much for you to do this at $80,000 of net income in the year. There makes no sense. You're going to be dealing with all of these things, and you're not going to save any net money. Yeah, maybe you'll save something in taxes, but you're going to be paying me more to do it. Why? Right? Monetarily, it doesn't really make any sense. So again, accountants are going to have their break-even point for their fees for you on when it would make sense to switch over. But all these things to keep in mind, S-Corp is fantastic, but don't be enamored by everyone saying you should be an S-Corp and then just go make the election. Your accountant's going to be like, okay, great. We're going to add on a couple $1,000 for this new return we're going to be doing for you. You save no money overall, so congrats. Do things with their advice, right? So make sure that you have good advice on that. And that is the end of this one. Fun concept.
Yeah, on S-Corps, we shut down more S-Corps than we open, typically, because somebody's cousin, friend, or previous accountant, previous accountant, whatever, set them up in an S-Corp well before they were ready to be set up in an S-Corp. And so all the costs and everything outweighed the savings. So medical reimbursement plan, I'm not going to spend a lot of time on this, just something I want you to know about. And let me go to this slide so you have his contact information. This is a rule where you can hire your spouse and you can you pay them a salary each year, and then you can reimburse them for their family's medical costs, their medical insurance, things like that. A lot of this stuff is deductible against no taxes whatsoever, or at best deductible against 2 of the 4 taxes. So now, if you have a spouse who's W-2 and all the medical is paid through their job, fine, don't bother with this. But if that's not the case for you, or you have a lot of out-of-pocket medical expenses, Marty Wapner, he's retired, but he does the second most of these in the country. He's still doing these. If you recognize anybody who watches CNBC, I'm obsessed with CNBC, but Scott Wapner is his son, who's on there for 3 hours a day. But Marty does the second most of these in the country, and if you haven't heard about it, it's fine. It's only been around for 100 years. It was actually set up because we were 100 years ago. What did we have as far as family businesses are concerned? We had family farms back then, and it was set up for farmers so that they could hire their spouse, provide them with medical insurance, and deduct it just like corporations were allowed to do. That's what it's for. If you have your spouse doesn't have to be full time. You just send them to the occasional open house, whatever. You can pay them a small salary every year. But if you have significant medical expenses or insurance costs, usually like break-even point is if you're out of pocket, non-deductible medical is over $2,000 a year, you're well past the break-even point on that. Can you do it in 5 minutes?
Oh, yeah.
All right. Mark's fast. And then I know this is a lot of information.